All right, let's get going. Again, good afternoon to most of you. Michael Moriarty, Chief Investment Officer of Wealthspire. Thank you for attending the third quarter macro and markets. As always, joined by my colleagues, Chris Maxey, Chief Market Strategist, Dimitri Katz-Nelson, Deputy CIO. We've had a consequential last 3 months since we were together, largely around resolution to a lot of the tariff uncertainty that was with us 3 months ago. Not fully resolved yet, but I think we're beginning to see the outlines of what tariff deals are going to look like. In addition, we obviously have the passing of the OBBB tax bill. And I think those directionally resolutions are large part the reason why equity markets are back to all-time high. Once we're going to try to unpack both of those, give you our sense of how the impact of those, both individually and netting out together. And then, of course, we'll talk about equity markets and fixed income markets. Hand it over to Chris Maxey.
Thanks, Michael. Yeah, so I think the word there is consequential, as you mentioned. It has been a consequential year for many reasons, both for investors, portfolios, the economy, and hopefully, as we go through the presentation today, we'll be able to walk through each of the items that we are all hearing a lot about, but try to think about it in terms of implications to each one of us. So, as we think about our outline today, we'll go through the big picture and then tie that in with the stock and bond market and give you a sense of our outlook on a forward-looking basis. We have received a couple of questions coming into the presentation today. If you have others, please feel free to submit those through the chat button, and we will either try to get to those as we're going through or circle back at the end of the presentation. As Michael mentioned, we have our three speakers, as everyone is familiar with, Michael, Dimitri, and myself. Hopefully this is not a new slide for anybody that's joined us previously, and we'll each chime in throughout with a couple of different perspectives. One of the things that we want to do today is provide contrasting opinions, if you will. So in a couple of different areas, as we think about things like tariffs, as we think about the tax base and the role that tariffs play, we'll give you perspective from a few different angles. I don't think the goal is that we're all going to agree throughout the entire conversation. And so we want to provide that perspective as we walk through. So let's go ahead and get into it. As we think about the economy, this quote really hit the mark. Just going back to beginning of year and where we are today, the economy, like the weather, has a way of fooling all of the people all of the time. And this quote is not a recent one. This quote originated 6, 7, 8 decades ago, and you could apply it to almost every single calendar year since then, but it feels as relevant today as it did back then. So many economists, when they were coming into the year, had this idea that, wow, things are going to be great. We're going to have this pro-business deregulatory presidency. And then as we saw coming into April, things changed pretty quickly. So why did they change? A lot of it had to do with the tariff announcements. And I think this is quite familiar to all of us at this point, but the president has indicated he wants to have tariffs and tariff agreements all around the world with every single country. Now, when we're looking at where that effective tariff rate is, and this is through July 14th, right now it's settling about 16 to 17%. This number is variable. It's been changing. Where does this bring us, though? This is pretty similar to where the effective tariff rate would have been on April 7th and April 8th, when markets were going through that panic period that we talked about a couple of months ago when we had this call and we had a few other conversations. So what we see right now is that the tariff rate is actually quite similar to where it was at that time. Primary reason the market is reacting differently is that there have been extensions, there have been pushbacks, there's been carve-outs, and as Michael mentioned, we're seeing the frameworks and the outlines of deals begin to show up. We've seen countries like Japan, the UK come come to the table and seemingly reach an agreement as best we can all tell. Other conversations are happening with China, Indonesia, any number of other trade partners that we have as well. So the tariff rate is settling in around this 15, 16, 17% level. You can see that the three big parties that probably deserve the most attention are Mexico, Canada, and China, just given the totality of our trade balance with each of those three countries. Now, one concept that does show up on here, which I wanted to highlight, is the idea of pre and post substitution. That simply means that as the price for certain things goes up, that's your pre-substitution. So people might have bought something previously that they decide they no longer want to purchase. Well, then they substitute in a different good or service. So what happens is as those prices go up, people swap into a different item, and that's what your post-substitution tariff rate is. So if people just walk forward, continue to buy all the things that they were buying previously, the tariff rate is going to be closer to around 18.5%. But as we see in the real world, that is not always the case. Now, why are tariffs becoming such an important part of the administration's policy objectives and goals right now? It comes down to this, and this being the amount of revenue that's being collected on a monthly basis. For the last 2 months, we have seen that tariff revenue is beginning to accelerate higher, and that started in April, really picked up in May, now jumped even further in June. And when you look at this on an annualized basis, we're talking about $300 billion of incremental revenue that is going to come into the federal government coffers throughout the course of the calendar year. So that would be at current rates over the next 12 months. Now, pre-existing this, if you go back to 2010, 11, 12, 13, 14, what you'll see there is that the revenue rate, or the revenue collections from tariffs was around $4 billion, $3 to $4 billion. We've had a tenfold increase from that time to where we are today. $300 billion to potentially $350 billion becomes a very meaningful source of revenue for the government. But what you'll also potentially pick up on or notice here is that those impacts are only beginning to show up in the economy over the last 2 months. If we had gone back to April, which was when the conversation around tariffs began to arise in the economy, the revenue that was collected was lower, call it around 15 billion. So that number is about 50% higher today. Why does that matter? It matters because a lot of the forecasts at the time said, well, second quarter growth is really going to get hit hard because tariffs are going to be felt immediately. And we're finding out that wasn't the case. Yes, tariff revenue is on the increase. Tariff revenue is quite a bit higher, but we're seeing that the economic impact is actually being pushed down the road a little bit. Now, that's not to say the impact is been totally muted. I think what we're going to find out, and one of the things we want to talk about today, is that we likely see the effects of tariffs begin to show up in August, September, October, November, and that's what we're hearing from a lot of the corporate earnings reports that are coming out over the last couple of weeks. So that brings us to one of the things that we want to spend a little time chatting about between Michael, myself, and Dimitri, which is the sources of revenue and receipts for the federal government. What we're seeing here is the proportional weights for each of these individual income tax receipts for the first time are more than 50% of government revenue. And then that line below that, that social insurance tax, that's payroll taxes. So you could think of Medicare and Social Security tax. And then you go really far down the list, you see corporate taxes. We have a category denominated as other, that's sources of revenue that are a little bit smaller for the federal government. And at the very bottom, excise taxes. So what are those? That is tariffs. Tariff revenue for the federal government has gone from 20% in the 1940s to as low as 2.5% in recent decades. That number is about to change. So one of the things Michael and Dimitri and I were speaking about prior to the call is, what are the implications of that change? What does that mean? You know, we're seeing here that more of the burden, if you want to call it that, or more of the receipts and revenue have come from the individual as opposed to other sources. And I think part of the conversation we had was there's a desire to move that tax revenue and burden away from the individual to other parties. And this feels like a natural one. So Michael, Dimitri, I
Yeah.
know we had talked about this. Do you guys have any thoughts?
Well, I think there's no question that the individual and the corporation have a very big say in Washington. The individuals elect the politicians, corporations have very well-paid lobbyists. Uh, hard to see how those, hard to see how we were going to get incremental revenue from those sources. And in the context of the OBBB, which was going to be further increasing the deficit, more revenue was needed, and tariffs were probably the least bad uh, source of that revenue. In addition, early on, we heard a bit of the justification for tariffs in terms of national security, onshoring or reshoring certain critical manufacturers. I think many people thought that was a bit far-fetched. We haven't heard any of that recently. I think most people recognize any onshoring of critical industries take years, and so I think it really is a revenue story.
Um, I completely agree. I think as Chris, we said, we're going to disagree, and this one is going to be
Yeah, I was
have a
about to
hard
say.
time with it. But I say this, it raises you now get the excise tax of getting close to 10% of federal receipts. That's a big number. That's a number we haven't seen going back a ways. Um, and I mean, just immediately, as Chris pointed out, that it's taking a little while for tariffs to hit um, the consumer as of yet. But as far as deficits, we've actually, I think, had 3 or 4 straight months of slightly reduced deficits thanks to that increase in that accelerated pace of tariff payment. It's not something that's going to sustain for forever, but that's one of those, little numbers like, oh, it was a 2 trillion, now it's 1.9, now it's 1.85. So it's helping on the margins, but obviously not materially.
Yeah, and something we spoke about on here as well is that corporate tax number, which if you go back to the 1950s was around 30% of government revenue, and today it's less than 10%. And when you think about the OBBBA, the discussion was that there may be further cuts alongside or in addition to the 2017 TCJA cuts that took place for corporations to bring that corporate tax rate even further down. We saw that that ultimately did not happen, and I think that's in part a recognition that corporate taxes relative to past history are a much smaller source of revenue than they had been. There are other carve outs, which we'll speak about, and some very positive things that are taking place for corporate America, which are going to be supportive for the stock market. But I just think as you look at the trends here and what was in place, it was somewhat evident that corporate taxes probably could not go that much lower. There could be a simplification of the corporate tax code, which is a bit of what we're getting, but the rate itself was not going to go down. Now, related to this is what's happening between underlying households, incomes, demographics, and a variety of different parties in our economy. What we've seen happen as you think about tariffs in particular is why has the impact not really shown up in a material way? Part of it is that companies they stocked up. They said, we know tariffs are coming. We're going to buy as many goods as we can to get ahead of that trend. But the other reality is that on the left-hand side, you have the top 10% of consumer households in the US, and this is based on pre-tax income. How do they allocate their money? Those top 10% of homes spend about 50% of all the money in this country. So what's relevant here is that when you look at their share of proportional spending, 13% goes to goods. And the goods are where the biggest impact has been seen and felt and is likely to be felt for spending related to tariffs. But there's also a buffer of savings, which is around 26%. So for every dollar, those households are saving 26 cents. That is not true on the right-hand side. Many of the conversations that we see happening or at least popping up in media in the Wall Street Journal and articles like Barron's are that we have consumer delinquencies going higher, auto loan delinquencies going higher. And yes, that's true in pockets, but I think as we've spoken about, as we've heard with investment managers we talk to, the pockets where the delinquencies are happening are in subprime, they're in households that don't have the benefit of the higher savings buffer, of the lower goods spending. And so that's why tariffs are having impacts, but they're not being felt uniformly across the board. So, Dimitri, Michael, I know we've talked about this as potentially being a bit of a has versus have not story. And I think that's true in a sense, but when you guys look at that right-hand side, the bottom 90%, does it give you any pause that the good spending is higher, the savings number is lower, and there may not be as much of a cushion?
I mean, there really isn't. The credit card delinquencies that are happening, the numbers that we're seeing is happening on the bottom 90 percentile range, and kind of the unique dynamics of tariffs and dollar, which we'll talk about later, is that it keeps inflation a bit elevated, keeps interest rates up. So as a net saver on the left, you're benefiting, right? You have higher interest rates, you clip a much higher coupon than you would otherwise. The good spending is not as punitive, but I think that it just is. So I think, Chris, as you mentioned, the top 10% spend are doing 50% of the spending. That's why, in aggregate, when you look at GDP, the numbers are still pretty robust, and they can stay there for a fair bit of time.
We're going to speak, a later slide is going to speak to real wage growth. And just remember these good spending numbers, 13%, 27% in that context, because if the average tariff is around 15%, to use rough math, multiply those good spending percentages by 1.15, and you can see the good spending for the top 10% is going up, call it 2%. The good spending for the bottom nine is going up, call it 4%. With the real wage growth, which we'll see of around 2%, the top 10% is making up for that tariff increase, and the bottom 90 is not making up for that increased tariffs.
Yeah, that's exactly right. And I think that's a good point. And that shows you the dynamics of the economy, why there are those headlines that pop up, create a little bit of fear, some level of angst, and we need to be attentive to them. But it doesn't necessarily signal to us that we're on that moment where the economy is going to slow down in a way that potentially leads us to a recession. So what we do want to do here is try and synthesize, at least on the tariff front, what's happening. So the recent past tells us that companies pre-ordered goods. We heard that from corporate earnings reports coming out of the first quarter. Companies said, look, we stocked up, we had everything ready to go. Those inventories and those stocks are now beginning to go down, and they're starting to run out. Consumers have purchased a lot of the items and goods that were there and available to purchase. That restocking now is going to have to take place in August, September, October, and we've heard discussion around that. The question becomes, what comes next? Are price increases going to get passed through to the consumer, or are they not? Most likely, from what we've heard, price increases are going to get passed through. Initially, foreign governments were not as retaliatory. We saw through a lot of the conversations that the US was increasing the tariff rate, and then corresponding countries were saying, we're going to wait, we're going to have the negotiation, we're going to have the conversation. If we need to increase our tariff rates later on, we'll go ahead and do that, but at least for right now, we're not going to. That created another release valve and lever for tariffs to not be as impactful as was initially expected. And then getting to what Michael was just saying there, the U.S. economy is a service-oriented economy, but that's particularly true for the top 10%, the top 20%, where 70% of GDP is allocated, 70% roughly is allocated to services. So when you see the increase of goods going up, that's being felt on margin. And now we have tariff revenue that is going to go higher, and that it should be expected that that is a source of revenue for the federal government, but that source of revenue means it's a cost for somebody else. And that's why we think you'll begin to see that coming down to the consumer level. Now, on a near-term basis, we talked about that inventory rebuild. Companies are going to be restocking, ordering goods from overseas. Now, one number that does come out of all this, the Yale Budget Lab has put together estimates and great data. So if you're looking to understand the tariff conversation and impacts on an aggregate economic level, the average household is going to experience an income decline of about $2,800 per year because of tariffs. That's a pretty big number. Like we said, it hasn't been realized yet. It's going to start showing up. So that's one thing that we have to keep an eye on. And we would anticipate that those retaliatory actions are going to start going higher. Now, in the context of tariffs being a cost increase and potentially problematic, what we have at the same time is OBBA. I think I missed a B. OBBBA.
Yes.
We put together a blog post, so Wealthspire on the website, if you want to learn more about this act and implications from it. There's a great blog post out there that our advisors put together talking about the implications from an individual level. So how do you think about financial planning? There's an increase to the SALT deduction. Individual tax rates are evolving. There's discussion around tip and overtime pay. From our standpoint, what we wanted to speak about was qualified opportunity zones and then bonus depreciation, because both of those have impacts to investors. As it relates
Yeah.
to bonus depreciation, the thing that I don't know that everyone was paying attention to, bonus depreciation currently was 40%, and it was going to start to decline in 2026, meaning that if companies went out and they spent on CapEx, building plants, they could write off 40% of that. That number is now being retroactively applied to June 19th at 100%. And the idea is that companies will go out, build factories, build manufacturing facilities, try to do some element of that reshoring Michael mentioned, although I don't know that that was all of it. And so that carries strong impacts to investors in that community. So Dimitri, you and I spoke about that, and then also opportunity zones.
Yeah, I think listen, the most of the things were just a continuation of the 2017 tax plan. So I do think there's a fair bit. I'm sure you can talk to your advisors. A fair bit of planning ramifications about increases in the estate, max and all the things that go with it. From an investment perspective, Chris hit on it. Markets, panicked in April because of tariffs. Because otherwise, we still have those tariffs, but you're starting to see, oh well, there's going to be a tax cut. Oh, there's going to be potentially pro-business legislation. OBBBA, OBBBA. I think I might have thrown an extra B in there. Is a step in that direction, but we're also anticipating deregulation. When it comes to what we're looking at is, one area that we did work on back when it was initially announced is opportunity zones, a way to defer realized gains, a way to invest tax-free over horizon. Bringing that back does bring those opportunity zone investment options into the fold. We're going to be looking at those, but really starting middle of next year. The tax benefit goes into effect in 2027. So from an investment perspective, you'll see we'll be spending calories there. But the bonus depreciation, I think, Chris, we were talking earlier, right? There's you're starting to see some of the big firms take advantage, accelerate R&D. Google, I think 70 to 80 billion, a pretty big increase and on that end. And you're going to see other firms put money in the ground because there's a benefit to it. So net, absent of questions about deficits, which we'll get to, when it comes to the markets, when it comes to capital markets um, and how it's been perceived, it's been a net positive for risk assets. Is how the markets have taken it.
Yeah, and I think you hit on something important there, which is that there's the idea of near term versus long term. Deficits are a long term phenomenon that are going to have to be addressed at some point. I'm not sure when that some point is going to be, but in the near term, you do have positive aspects for individuals, households, consumers, but also corporate America and ultimately the stock market that need to be understood. And so, in trying to understand those, when we look at the act, the Reconciliation Act that was approved or signed off on recently, the percent change to GDP, as you look here in 25, relatively small, but it's designed, or at least as under current estimates, it's expected that's going to add about 3/4 of a point to GDP growth. So as we think about tariffs, we'll show you this in a moment. Tariffs are net negative, but looking at the Reconciliation Act, it's going to add about 0.75% to GDP growth next year for the US economy. Now, moving beyond that, the impacts begin to wane. So they go down into 27, 2028 before starting to gradually pick back up. But over the next decade, it's estimated that around 0.5% of GDP growth is going to be added above and beyond where we've been recently. Now, Michael had a bit of a quibble with the way I initially created this chart, because when you look from left to right here, you'll notice a few things that stand out. This chart is showing you the net impact of tariff losses and the Big Beautiful Bill Act that was passed and signed off on July 4th. And this looks at the income impact by each of the deciles. Now, when we had initially looked at this, and Michael rightly pointed out, the OBBBA benefit was actually showing up as positive across all deciles. So from the bottom 10% to the top 10. But some of the estimates that are out there, or certain of the estimates, are excluding any change to SNAP benefits, so food stamps, for instance, and Medicare. So that was a relatively important exclusion for those households. And so what you now begin to see is at the bottom 10% level, the net effect of their income is that it will decline by about 6%. And then it gets a little bit smaller or incrementally higher as you go from left to right, before you have that crossover point around the 30 to 40 to 40 to 50% income households, where you then begin to see there's a positive effect. Now, Michael, as we spoke about, this gets exactly to that idea we talked about before, top 10%, top 50% versus the bottom 50, and why this is relatively important. But hopefully this representation, we're okay now.
Facts are the facts.
Yes. So I would also point out this is potentially going to change because this underwrites tariffs as they're currently written. It doesn't take into account any easing of tariff negotiations if there's a rollback, if those numbers begin to come back down. Now, I do want to talk as we think and start to unpack the longer term. We mentioned the deficits there, and there's a few items here. One is the receipts, the other is the outlay. So this is what the federal government spends each year as a percent of GDP, and then how much it takes in as a percent of GDP. This references back to that composition of receipts that are coming into the government. There's an interesting observation, though, that is not terribly widely discussed, which is this idea of Hauser's law, which comes out of an academic paper, that as you look at that receipts number for the federal government, no matter what the tax environment has looked like over the last 70 years, going back to the 1940s, moving all the way forward, the receipts have very consistently been around 19 to 19.5% of GDP. And that includes all sorts of changes to the tax code, the tax law. So it seems as though that number is routinely running around 19 to 19.5%. The divergence, though, is on how much the government is spending. The blue line on top, as you can see, the two numbers were married for the first couple of decades, excluding World War II. For a long time, they were married, began to run a deficit in the 1970s and 80s. We had a balanced budget in the late 1990s before deficit spending started to increase, and that became especially prevalent in 2008 and then 2020. Now, it's not a bad thing to run a deficit of around 3 to 3.5%. Where it becomes a little trickier is that when you're in a recession, you anticipate running a wider deficit, and we're running recessionary style deficits right now. I know we spoke about this. Is there any answer to this in the near term?
Not near term, no.
Then
Also,
when?
too, what's interesting is the current deficit, the difference between those two lines of revenue and the spending is akin to what it spiked to in the global financial crisis, which again, to your point, makes perfect sense to run deficits in certain periods. But we're not in a recession. We're not dealing with financial crisis. We're not dealing with a once in a 100-year pandemic. Yet we're still running a very healthy deficit.
Yeah, and it begs the question of when we do go into a recession, what are we going to be able to do? What tools will be available? I suspect there's a lot of creativity and that could be solved for, but at some juncture, this is going to require addressing. Now, related though, if we look at whether this is a U.S. centric problem or not, the reality is it's not U.S. centric. And what happened, which is a very important development, when you look right in the middle, there's a column that shows us U.S. debt to GDP for all of the major sectors. So households, companies, and then banks, in addition to the U.S. government. What happened was that it's the debt simply moved from the private sector balance sheet after 2008 to the public sector, and that's where the U.S. government has now stepped in for quite a long time now. But take a look at everything to the left of it: China, the UK, France, Canada, and Japan. This is not simply a US issue anymore, and I think that's one of the things as we look at the Japan experience. Debt to GDP in Japan is nearly 600%. That's double where the US is currently, but we're beginning to see that Japan is feeling implications from that as interest rates are rising, and there's questions about how they're going to continue to pay that higher debt load. But this also gives us reason to have a little more optimism about the US economy, because as much as the US government has increased its leverage, we've seen that deleveraging take place in the other three sectors. So corporate America has delevered, individuals have delevered, or households have delevered, and we also see that with the banking sector. That means there's capacity, there's opportunity to pay off all that debt, to potentially increase it, and the balance sheets are relatively clean. And that's something that gives us a certain level of optimism. Now, so I want to bring that all full circle into what's going on this year before we move over to talking about the markets. On the left-hand side is economic forecasts for GDP this year, quarter by quarter, and then right-hand side is inflation forecast. When you go back and look starting at the end of March, all of the economic forecasts got cut. First for second quarter, third quarter, fourth quarter, so entire year, economists were saying, well, this is going to be bad. Tariffs are not going to be good. Lo and behold, we begin to move the calendar forward. Second quarter forecasts have now gone back up to 2%, and we've seen third and fourth quarter stabilize. What this is telling us, and something we shared at that point in time, the economy is still growing. In as much as forecasts were being cut and slowed, they were not negative. So nobody was telling us that the economy was going into recession, but that was by and large the headline a lot of people were taking away. Now, where you have to pay a little bit of attention, though, is on the right-hand side, because inflation is now at a higher plateau. And it's likely that through the increased costs associated with tariffs, we're going to have higher inflation coming into the second half of this year, beginning of next year. And that may be temporary, that might be short-lived, but if we get things like lower interest rates, that could stimulate economic activity, could re-stimulate the real estate sector. Those are things that could, again, put a little bit more pressure on inflation. And that's why we've talked about securities like TIPS and finding those particularly interesting in this environment. In thinking about overall, what are the big things that you should be paying attention to? It's the labor market. If people have jobs and they're employed and their wages are growing, they're going to continue to spend money. We've talked about never betting against the U.S. consumer. That is yet still showing up as the case. And the unemployment rate, it's a little bit higher, but it's nowhere near where we would say there's an alarm bell ringing. And jobless claims, same thing. We do see that more people are on continued jobless claims. So that's one of those things that you could pay attention to, but it's a very preliminary indicator. Those continuing claims are for people that haven't been able to find a job and they're continuing to collect unemployment benefits, but we don't see that there are more people initially claiming those benefits. So that's something to keep an eye on. But again, there's no sign of serious weakness in the labor market. And when you talk about the balance sheets, this is a busy chart, but I can get you to focus in on two colors. So as a colorblind person, I might identify the wrong ones, but I'll just say within each of those ranges, it's the first and the last bar, which I think is green and perhaps an orange. I can't quite tell, but
we'll go with orange.
All right. That's 2019 and then the end of last year. What you're seeing here is the amount of debt that each household has or each income level has relative to the assets. And the number is down in every single case. Why is that? It's because debt has either stabilized or come down, but the asset values have gone up. And the most obvious example of this is the housing market, where home prices are up by 40% in many geographies. Meanwhile, people have been paying down their mortgages. They had that 3.6% mortgage rate locked in. So you continue to see that balance sheets are very, very clean as a result of this. Deleveraging has taken place, and that's a very strong indicator of economic health for the U.S. more broadly. Michael mentioned that we're going to talk about wage growth. With a strong labor market, what you tend to have is strong wage growth. And labor markets are currently tight for a variety of reasons. One that we haven't spoken about is immigration policy, which potentially removes a subset of individuals from the labor pool. But take a look on the right-hand side. That's your year-over-year real wage growth. Today, it's around 1.5% or just under. That's as good as we saw from the entire period from 2008 until 2020. So for that 12-year period, we only for a short period of time had better real wage growth. And when you have real wage growth, it means that people's economic prospects are getting better and better above and beyond the cost of inflation, above and beyond the cost of their everyday living. That was not the case in 22 and in 21. And that's part of why we saw markets selling off and the levels of angst were going up economically. People were calling for a recession. That's not the case any longer. So I'll summarize on a few things that we're paying attention to. When we were talking at the beginning of the year, we were operating with a very generalized framework of what was going to happen. But we outlined at that time the three areas to focus on were tariffs, taxes, and deregulation. We have more clarity on taxes. We have further clarity on tariffs, and deregulation. We have a little bit of clarity, but we don't fully know what's going to happen yet. A couple of things have happened with the banks and the financial sector, but when we're looking at the known knowns and the unknown knowns, that there's more that are now moving into that camp of being known to us. That reduces uncertainty. It instills a slightly higher level of confidence for investors. One area that's down at the bottom, though, we've got to pay attention to is that US dollar. It fell 10% in the first half of this year. Largest decline, as we've talked about, since the 1970s for the first 6 months of a year. And that will put a bit more pressure on inflation, because now as we bring goods in from overseas, it potentially makes them more expensive for us.
This is where I get to disagree with Mr. Maxey. So no, obviously that number is accurate, but we even wrote about this recently. The dollar declining 10% happens pretty regularly. I think 5 to 7 times going back the last 20 years. We just pay a lot more attention to it when it's, January 1 through June 30th than it is from random day in October through a random day in August. But it is a fair point. We're actually going to talk about the dollar in what was been driving returns overseas year to date, and I think there are some ramifications long term as we think about it. So decide to jump in on your parade, Mr. Maxey. Not rain
No,
on it,
that's
but just
fine.
jump
You're
in.
exactly right. It was a bit of a data mining crime there, if you will. So let's get into the stock market then and what we see happening.
Thanks, Chris. So I'll hop in. First, your obligatory annotated chart of what's happened to the markets. We're not going to speak through all of this. I think we were on this call previously. We had a couple calls in April. First one was kind of immediately after the tariff announcement. Then we had our regular one, and that was kind of when the orange was near its lows, and there was talking about, from a 25% probability recession to 75, subsequent acceleration in kind of the tariff rhetoric and everything that's happened since. And lo and behold, we're back to all-time highs. And we always say this: all-time highs beget all-time highs. There's a lot of research being done. If investing in an all-time high versus a random day, you're doing quite well investing in all-time highs. Well, there's a chart just showing you what's been happening with markets and the headlines around it. If we jump to the next slide, we'll get into the details of just broad equity market performance. So in blue, you have what happened in 2024. That was obviously Mag 7, mega cap, all the growth you can stomach. That was driving returns. This year, earlier in the year, that was not the case. The Mag 7 was lagging. Large cap stocks were struggling. They've come back a fair bit. Small mid cap stocks are probably still struggling the most. They have the least amount of those tech names, a lot more industrials, a lot more the rest of the market, where higher interest rates are a question, and obviously the tariff policy is a question. So as the closer we get to resolutions on those, or at least some transparency, the more you get a pickup in expected growth and expected margins. But for now, we've seen that part of the market kind of hold back. I think the big numbers are here in the middle, which is the MSCI EFA. Think about it as the developed world, ex-Canada. You can ask MSCI why that happened when they designed those indices back in the day. And then you have the MSCI emerging markets, and both of those are outperforming US year to date. So you can see, think of EFA as being Europe, Japan, Australia, up almost 20% year to date. And half of that's currency. So Chris mentioned the dollar being down 10%. If you own non-dollar assets, that's half the returns currency, but it's not all currency. So even if the dollar was not moving at all this year, international would have outperformed. And this is not necessarily saying this is a sign that international is going to continue to win, but we do want to focus your attention on a few things happening there because it is relevant. But before we get in there, just a couple more slides on fundamentals and kind of what's happening in U.S. markets. So first, we're only a few weeks into earnings season. I think only 10 or 12% of companies have reported. So we don't have a great view of where earnings are yet. But from what we've seen thus far, earnings are positive. Earnings growth is in the 5 to 7% range in the US. Actually, weakness in energy, but generally positive earnings. So that helps. That's a fundamental. We always say markets follow earnings. Earnings are still positive. The second piece is on this chart. And this is a chart Chris grabbed, but talks about buyback activity. How much are corporations basically going out there and buying back stock? And right now we're on a run rate of close to $1 trillion. That's around 1.5 to 2% of the stock market disappearing, in any given year. This is actually pretty normal. If you can look underneath, this is within the path that we've seen for going on almost 2 decades. So buyback activity has been aggressive. It shrinks the size of the market to a degree, meaning that your dollar of earnings is increasing because it's going to fewer shareholders, right? If you have $100 in earnings and you've reduced your shareholder count to 98 to 96 and so on, your earnings per share grows. So we have fundamental growth, plus growth from companies buying back stock. And I think the difference between now versus 15 or 20 years ago is for a while, the US was the only game in town in buybacks. We were the only country that were aggressively buying back stock. That is not the case anymore, whether through shaming, whether through aggressive kind of corporate changes in stakeholder, shareholder behavior in Europe. You're seeing share buybacks in Europe, you're seeing share buybacks in Japan, and we'll touch on that in a little bit, but still, companies continue to buy back stock. Second piece we'll touch on, I think, is we have to, is AI. One thing I was in vet with Janet Yellen when she was in her prior role, talking about what the Fed knows and what the Fed doesn't know. And I think the one thing they highlight is that the Fed is very good at everything, but they don't really understand how to model productivity, or that component of what drives GDP growth above and beyond, the uh, 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 basically the GDP and everything else. And we are getting more productive, and the U.S. productivity growth has been close in the 5% range, I think, recently, where we saw. So the reason we talk about AI is because a lot of the talk is about AI bringing future productivity growth. And as far as a variable being in place to say, hey, how can companies stay this profitable, if how can margins stay this elevated if we're going to have increase in tariffs or higher wages and so on, is you are seeing this productivity growth. You're seeing this, and one mechanism to show that is AI use. So, AI use, growing and projected, it's going to 8%, 10%, 12%, and beyond. And I think there's no slowdown there, which is why you're seeing the hyperscalers, the mega cap growth still continue to perform well, because they are a lot of the generators of this. But now you're seeing other companies leverage it, bring more profitability, which is ultimately good for corporate America.
Yeah, and I just wanted to point out this data is based on asking people, are you using AI and how
Yep.
frequently are you using it? It's not simply an estimated or extrapolated data set that anybody could make up. This is the U.S. Census Bureau going out to companies and saying, how frequently are you using it? And as you can see, going back to the beginning of the year, it's accelerated quite a bit since beginning of year, where there was a little bit of growth happening, but now 2025 is taking place, and we're seeing a very different paradigm.
Absolutely. Thanks, Chris. So we touched on international. I wanted to bring some charts here. So first and foremost, on the left, you're seeing earnings per share growth estimates for 25, 26, and 27. And we'll bring your attention. The US is still expected to outgrow non-US stocks. The US is where, outside of China, where you get a lot of these um, AI-driven names. But you are starting to see that difference between US and non-US narrow going forward. And we've been seeing that this year. Actually, earnings growth overseas has been quite strong, but you're seeing the expectations narrow. So international doesn't necessarily have to outgrow the US. It's growth and then the relative valuation you're paying for that growth. So the reason that I think you're starting to see some of the international come back is because they've been trading at a lower multiple. That's the information you see on the right: price to earnings, price to cash flow, where the margins are, and also expectation of earnings growth. So another reason that's been helping you international year to date above and beyond the dollar weakness. If we go and to bring it all back, it really is I think we always talk about focusing on fundamentals and what drives long-term returns. We're still back looking at fundamentals. So right now, probability of recession remains low. Corporate profits remain quite high. The ability for corporations to pass through tariff costs, whether folks like that or not, has been pretty high as well. So margins have not been hit yet. You've seen an increase in buyback activity domestically and overseas. You've seen a fair bit of corporate-friendly activities overseas in general. There's actually been a lot of C-suites being replaced when they're have shown themselves to be bad capital allocators. That is a shift, and that's taken a decade plus to get through. We've had the passage of the OBBB. That takes one variable out of the equation. The more variables we get out with regards to the tariff settlements, I think the numbers with Japan was 15%, but I think there was exemptions on auto and a few other things that make that number much, much lower. So the more transparency we get there, the more markets is why you're seeing the markets continue to move up. And obviously, the next step is everyone's waiting to see what deregulation looks like. And that we don't have final assumptions there, but there could be more flexibility in balance sheets, which may lead to more lending, which may lead to more growth. So for all those things being said, obviously we don't love valuations when they're quite elevated, but markets are finding those variables, those drivers to say, hey, the future looks like it's going to be okay, and that's how we're seeing markets behave year to date. If we go to the bond markets, it's a Jerome Powell quote. So, all right. So, Chris, I know you put this guy says, as far this is kind of in context of expect where interest rates are going and expectations, and says that no one holds these rate paths with a great deal of conviction, and everyone would agree that they all are going to be data dependent. All it's saying is when you're seeing the Fed dot plots or otherwise, they're they're an estimate based on the data that they have, and as the data changes, the Fed's going to change their mind. That's what they've been doing. That's what they continue to do. In the next couple of charts, we'll just walk through some of the bond questions that we have that we're getting. So first, bond returns year to date. And you can see last year in 2024, it was a year that if you were in high yield, if you were taking credit risk, you were rewarded. You're still being rewarded for that in 2025, but you're not necessarily being as penalized for owning interest rate risk. If you're owning treasuries, they're holding up reasonably well. Investment grade corporates holding up well. We'll touch on munis, which is kind of a unique environment. But generally, it's been coupon clipping, slightly better than coupon clipping in some areas in the fixed income markets, despite all the interest rate volatility we saw in April and hence um, and thereafter. We go to the next slide. We want to touch on basically the inflation and the Fed. So there's been talk from the administration, been talk for others that want the Fed to be more dovish, right? There's an expectation that we should be able to borrow at significantly lower rates. That's going to give us a lot more fiscal flexibility. If we're not spending so much money on interest payments, we could be spending money on something else or saving money, cutting taxes even further. But Fed data dependency is real. They've communicated this, and regardless of who the chair is, there's data dependency. And right now, inflation is still running north of 2.5, 3%. And even if the Fed gets to its target, which I think it's kind of an average, so I think the Fed would be happy at 2.25, 2.5 at this point. They're not going to be very aggressive in cutting rates unless they see significant deterioration in employment. Chris showed you employment's been okay, inflation's been sticky, so the Fed is sitting on their hands a bit. Now the expectations are 1, 2, maybe 3 cuts this year. Earlier this year, in April when there was a lot of fear, there was expectations of 6 or 7. But right now, I think to expect to see an aggressive Fed, you need a significant deterioration in employment or a significant decline in inflation, and that's why I think the expectations are the Fed's going to stick around here. That means higher for longer for rates. As everybody, most of the folks on this call are net lenders. That's a positive for you all, but we'll get into a bit more detail on that. So one thing that we want to talk about is just what's happening to the yield curve. And there's a lot of ways of showing the yield curve. We think this is a good one. This is a chart showing where the 2-year treasury yield is, the 10-year and the 30-year. So when the light blue is above the orange, which is above the dark blue, the yield curve is positively sloped. You're going to get paid more on longer dated debt than shorter dated debt. And there are periods when the curve inverts, and there's sometimes that's triggered a recession, sometimes not. And that's kind of the modus operandi that we saw from 22 through to 24. You had some inversion. Right now, what we're seeing in the markets is, especially once the Fed cut expectations came down, is that markets are, one, expecting higher for longer. Two, the inflation concern is what keeps the long end of the curve higher. So you've seen this widening at the 30. You're actually getting paid on 30-year debt more so than 10-year, more so than 2-year, because there's this expectation that the Fed can't be too aggressive in this environment, and inflation is going to be sticky. So that means positively sloped curve, which, by the way, is normal. We want a positively sloped curve. That's a normal environment. Inversion means something is wrong. We go to the next slide. I want to touch a little bit about munis. So since the chart always takes over the conversation point, I'll talk about the chart first. The chart talks about rainy day funds on municipal balance sheets. Think about is how much cushion municipalities have built up in order to go through a COVID type scenario, go through potential reduction in revenues from whatever it may be. And we'll tell you that right now we're in a much better place on an absolute relative basis than we were back in 07, 08, back in the early 20 teens when there was concerns about muni solvency. Munis have built up a fair bit of cushion to be able to handle what's happening, which is the question. Some of the things that come out of the OBB. So the chart on the bottom just gives you an idea that municipalities are still in pretty good shape, and the vast majority are AA and up if you're looking at general obligation bonds. But really focusing on the biggest questions we're getting early this year is ahead of the tax plan is the OBBB going to remove the tax exemption status of munis. That was a big question we were getting in the spring. Untouched. So munis are still as tax advantaged as they used to be. No change there. There was a slight change to SALT cap. I think realistically it wasn't a huge difference one way or another. I don't know. Some of the advisors will talk about the P's and the SALT and those offsetting, but really not a significant fundamental shift in the taxability of munis and kind of the flexibility there. There was a lot of talk about the endowment tax and endowment tax hitting universities, and it is going to hit some universities. But if you're talking about the really scary number, that 8+% number, that's only hitting 5 schools. It's 5 Ivies. Won't go through them. You have an idea of what that is. So I think fundamentally municipalities are probably breathing a sigh of relief of what came out of the tax bill, and what they're getting ready for is, the Medicaid cuts are going to take effect. That will reduce funding. They're very backloaded. There's time for them to get through it. There's some time for them to set up accordingly. We do think, and the managers are obviously going to tell us this, is that there is more underwriting matters when you're getting these big changes in fundamentals. So the active municipal bond managers will tell you you'd rather be more active in these environments to avoid the wrong hospital in the wrong place. But broadly speaking, I think what's really happened this year in munis is, one, we didn't get the scary moment. Two, munis came into the year fairly rich. They were the yield you were getting in a muni relative to a comparable treasury was pretty tight. It's since widened. That's hurt you as an owner. If you've owned a 15, 20-year muni this year, you're not loving it. But it's thinking about long-term expectations, that does help you a bit. So whereas earlier in the year and middle of last year, we're talking about, hey, if you were in a 25, 30 bracket, maybe just buy taxables, depending on the state, right? Obviously, there's some high states. Now munis are becoming more compelling at a lower bracket. So it's something that we'll be, discussing more and more in the coming months. I think, if I remember correctly, that's my last slide. So
that is it. So we're going to wrap up with the outlook. We have a couple of important questions that came in, which I would like to leave time to address. So in terms of our outlook, I think the biggest thing is that bullet point there in the middle, which says confidence is returning. And it's not just about confidence, it's also about clarity. Clarity from an economic standpoint is coming back since April, and that is diminishing the uncertainty that's out there. It's allowing companies to think about what their spending plans are going to be going forward. Earnings have been perfectly fine. There hasn't been a tremendous amount of worry on the earnings front, and we'll start to learn more over the next couple of weeks than going into Q3. We'll find out more about the trade deals, what those look like. Still some level of question there, but we're, as Michael mentioned, getting the broader fine points on trade deals, and that has been important. One area we didn't talk about, which I think we'll do a deeper dive on next time, is the implication of immigration policy, because that is going to impact labor markets and by extension GDP growth. That impact hasn't been felt yet, but those two things will begin to show up just in terms of, if we have a larger labor market, then you tend to see that GDP expands at a faster rate. But if labor is not growing at that same rate, GDP is not going to grow as much. Michael, I don't know if you had a couple comments you wanted to add before we get to the Q&A,
Sure.
but
Yeah, I'll just repeat a sentiment that we've shared in the past. We all remember, most of us remember, the pain of 2022. That probably the surprising level of pain was as a result of the very rapid rise in interest rates. We said at the time that yes, that was painful, but it was setting the fact that rates were now that much higher was setting up diversified portfolios to really start enjoying kind of mid, high single digit type returns for the foreseeable future. Now, obviously, that's dependent upon what your risk, how you're allocating your risk profile, et cetera. But as we've said, fixed income has done what you'd expect it with rates where they are so far this year. Diversified portfolios have generally done well. To the extent you have international equities in your portfolio, which our model portfolios do, that has been accretive. And so things have generally been working okay. Like Chris said, earnings have been okay. Portfolios have been good. I continue to think that we remain set up well for that kind of mid high single digit type levels.
Yeah, thanks. I think that is an important reminder for everybody. Diversification is working this year. It's done its job, whether it was international stocks or bonds. There have been additive parts of portfolios that weren't as additive in years prior, and it's great to see that taking place. So a few questions. One was with respect to the tariff rate historically. That number has been about 2 to 3%, going back to the era of globalization and post World War II. Predating World War II, tariffs were around 15 to 20% on average across the board for the US, but that number had come down for a long, long time. So that was one of the questions that came up. One which I think is going to take for perhaps the rest of the call is, do we feel that with economic activity having increased, that we, being the US, can grow our way out of the current debt picture and situation? We talked about that early on. Are we going to be able to grow above and beyond where debt levels are growing?
Possible. I think there's still more to finalize. The big one being the degree of deregulation. I think the assumption is that the Trump administration largely is pro-business, so you would have to think that um, it will be more deregulation than re-regulation. We touched on AI. You can chart a reasonable path for us to grow out of the deficit, the high deficit level. Don't know yet.
Yeah, I think that yeah, the big numbers, as we all know, listen, if the Fed cuts interest rates, it does create financing. It does. I think we're spending what 7% of GDP on interest. I forget what the numbers are. So you've reduced that liability, but it's ultimately it's going to be entitlement program reform at some point, whenever that is. If you combine that with what Michael pointed out, productivity, growth, the deregulation, higher tax receipts, all of those things, then you can potentially get there. I think it'll be hard to do it one-handed though. It feels like you need a two-handed fight for that one.
Well, and there was a secondary question tied with this, which is there going to be any implication for investment portfolios? And I think there is one that perhaps isn't always intuitive to people, which is that if we have inflation a little bit higher, it means interest rates are likely to be higher. And for savers, their portfolios are going to generate more return and income. There were some numbers we were throwing around about the amount of income coming off the fixed income market in total. Do you remember what that was? Because it's pretty
Yeah,
big, wasn't it?
yeah. There's actually well, it's a stealing from Rick Reader at BlackRock, but he pointed this out, and this dynamic of higher interest rates means higher cash flows coming from the lenders to from the borrowers to the lenders. And I think of dollar denominated debt, 1.7 trillion in annual, you know, basically coupon payments. If you go globally, it was something like 2.7 trillion. That's a big number that has to go back and reinvest or relend or re everything. So you take that, you combine with uh, you know the trillion in stock buybacks, and you're getting a very different point of view of how money is going and where money is going, relative to just kind of sticking back and looking at whether GDP growth is going to be 1.5 or 2%.
Yeah, there's a lot of money coming out of companies from the debt market as well as the stock market. That $1 trillion you mentioned on the stock side, 1.7 trillion in the bond market, like that gives you a pretty strong sense as to why
Oh,
markets overall are well pinned and supported in the recent environment. I don't see any other questions. Dimitri, Michael, any other parting thoughts or words of wisdom?
uh, I'll give my 2 cents. We talk a lot about the numbers that we're throwing out are very hard to rationalize in many cases, right? We're talking about trillions and hundreds of trillions. So um, I think kind of taking a step back and just level setting on these things. The 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 tariff component is potentially increases our revenues by 10%. 300 billion in tariff revenue is about half the revenue of an Amazon, and it's a little bit less than half the revenue of a Walmart. So as you start kind of bringing it to your day to day, you start thinking what those numbers really are. But I feel like I always have to do a better job in my head of like what does 10 trillion mean? What does a trillion mean? So bringing that down, I think I'll have to contemplate how to do that going forward a bit better.
Yeah.
think that's a wrap then. Thank you guys for the session. Thank you for those on the phone for listening in. Enjoy the rest of the summer, and we'll be back together in October. Thank you all.